Hey, it's Nathan Krampe. I make these videos because you are likely very ambitious about your wealth plan and your financial future. You want to have an impact in your family, your community, and your company. And to do that, you want to learn about great opportunities. So today, we are going to learn about great opportunities that you have in risk management. We're going to take a look at FTX, the cryptocurrency exchange that went from being a $32 billion company to bankrupt virtually overnight, and what that means to you in your wealth. Enjoy. There's a lot that has happened recently, and we look at FTX, the cryptocurrency exchange that went from being a $32 billion darling of Wall Street to bankrupt virtually overnight. Okay, so why is this important to you? Because most likely you have never had investments in FTX. Well, you've most likely never have had even investments into Bitcoin or into Ethereum or any of the other cryptocurrencies that are out there as well. So what can we learn from this? Well, that is what we're going to be talking about today, that there's a lot out there. And I want to start with number one, that risk happens fast. Okay, so like I said, risk does happen fast. And what I mean by that is when we take a look at FTX, they went from being a great company to bankrupt overnight. Well, what are some of the elements that we can learn from this? Well, first off is the fact that yes, we can have something that goes against us very quickly for an investment. Now, that's something that happens. Those things happen from time to time. Not all the time, but from time to time, we can have something that goes against you very quickly. So the risk that builds up can happen very fast. So while that's just invested into, say, one type of a company, we can do and have risk in other types of companies and in the bond market as well. You see, when we take a look at bonds, we have regular bonds that are from the federal government. We have bonds from the state and local governments. We even have bonds from companies. And let's take a look at a company bond first. We can have a bond that is actually going to do well, pay out a good amount of income, but then overnight, if the company fails to make that bond payment, that bond becomes worthless. Well, that is the risk that we're talking about, that risk can happen, in this case, overnight. So that risk can happen fast. Now, what do we do about that then? When we take a look at the risks that happen fast, we can start to say, here are some changes that we can be looking at to make with the investments, but also with your overall wealth plan. You see, risk in your wealth plan can come in the form of risk management with insurances. So your life insurance, your long-term care insurance, health insurance, all of these things can be different risk management strategies. So plugging those gaps can actually have an improved aspect when it comes to your overall wealth plan. And knowing that it happens fast is actually very beneficial so that we can make sure we have all the gaps plugged. So when that risk comes, you're not caught off guard. Number two is high risk. Okay, we talk about high risk when it comes to investments, yes, because we take a look at the fact that there are some stocks that can be higher risk than some bonds. Now that's just inherent with investing, that some are higher risk than others. So you may have a stock that's a higher risk than a bond that's out there, or a stock that's a higher risk than another stock that is out there. Maybe you have more of a speculative type of real estate that you're looking to purchase versus a more conservative one that's paying out stable investments, interest and dividends. Well, all of that comes back down to the inherent risk, and there are high risks with investments. Now, this, like we talked about, cryptocurrency exchange was a high risk exchange, a high risk company. Well, we can start to work with those risks though. So even though it was a high risk type of investment, the same is true with your overall wealth plan. There are other elements that can be higher risk. Say, let's take a look at your health. Maybe your health is not where you want it to be. Well, that actually is increasing your level of risk. So having the correct health insurance is going to be very vital. Maybe it comes back down to your nutrition. Well, we can do that with every element of your wealth plan as well. Take a look at the high risks. Maybe it's that you're actually aging to the point that that life insurance policy is going to be paying out sooner rather than later. Well, making sure we're taking care of there, making sure we are knowing who the beneficiaries are, they're going to the intended people. You see, all of that comes back down to what we talk about with respect to high risk. And that alone is going to have you be thinking more about your overall wealth plan and the ways that you can be reducing your risk correctly. Number 3 is place only the amount of money into an investment that you can afford to lose. Well, here's the thing that we can be talking a lot about, that is the fact that when we take a look at, say, FTX, yes, that was a company that maybe you actually were invested into. But if we only had a small portion into that, it's not as big of a deal. You see, if we had maybe, say, even 1% or 2% of your wealth, yes, that would be detrimental just to your overall psyche, but that's not detrimental to your overall wealth plan because of the fact that you had a lowered amount of risk. Well, we can start to take a look at every investment that way. We can start to take a look at the fact that we have Apple in your portfolio or Amazon in your portfolio. Both are great companies, but if they are an uncommonly large amount of investment that we're in, then we can start to have risk. So let's take a look at those two companies in particular, Apple and Amazon. Well, we have Apple that is in many people's portfolios, whether you actually know it or not. If you're invested into the S&P 500, that's going to be a part of it. Well, if we're invested into Apple just as a stock in general, you have it. But let's take a look at Amazon. You have Amazon most likely part of your portfolio in one way, shape, or form as well. Well, Amazon reports earnings and it crumbles, it tanks in the stock price. Well, Apple reports earnings and it didn't go down nearly as much. And in fact, there was actually a point in time that it went up in value. It all depends. It all depends on earnings. It all depends on where we're at with those companies. But what we saw then is that maybe the reverse could happen. Maybe Amazon goes up and Apple goes down. But if we had, say, too large of a percent into Apple or Amazon or any one company like FTX, that can really start to hurt us. And so the best element then is diversification. And when we take a look at diversification, it's not one to say we should just have it in Apple, Amazon, Google, Facebook, what have you. It's to actually take a look at and say, well, if we have it in Apple, there's going to be a lot of other companies that are going to go up and down in the exact same manner that Apple does. And that's called correlation. Now, what we want to see is actually having a negative correlation. So if Apple goes up, maybe another stock goes down. Because what happens then is that lowers the overall level of risk in your portfolio. So look to different elements of correlation. Bonds can provide that. Stocks can provide that. Real estate can provide that. Alternative investments can provide that. There's a lot of different elements out there that you can be looking at. But if we take a look at diversification in that way, then we can start to take a look at the fact that if something happens to one type of investment, it doesn't happen to the rest of your portfolio. We can also take a look at your wealth plan the same way. Maybe there are some risks on the table that we need to be working to diversify away from. And a lot of times that's using the insurances. So remember that it's not only just the investment fund part, the investment part that we need to be working on, but also the wealth plan to lower your overall risk. Number 4, risk can happen to any company. What we've been talking about now is that really there's no company that is immune from risk. And so when we take a look at, say, Enron or WorldCom back in the day, they were darlings of Wall Street. They were great companies, but they were doing deceitful practices. And sometimes we don't know about those deceitful practices until after the collapse of the company. So case in point with FTX, we saw some rumblings, some inklings of that, But that wasn't that really worrisome until actually the collapse of the company, and then we really started to see the practices and some of the hardships start to happen. Well, that's true that any company can be like this. So whether it is FedEx, well, they are one of the world leaders in transferring packages around. Well, they're already starting to say they may have issues because of what's going on with the economy. Well, that could translate into the fact that maybe Amazon is having some issues with the purchases and how many people are buying and selling on Amazon. Or maybe it's looking at other companies like Facebook and Meta. Well, they may not be doing it as well. Or maybe it's Apple. And Apple is a great company, but if they are tied to the world economy and selling their products around the world, well, maybe there are areas in the world that just aren't able to buy their products in the same way today as they once were. So what that means, and if we take a look at all the different investments that you have, and things like risk can happen to any company, and it's just based upon the fact that maybe it was something that they knew of or didn't know of, maybe something you knew of or didn't know of. But to understand that risk can happen also helps us to look at that diversification. So that really gives us the ideals that we don't want to be overly aggressive into one area. And I want to go back to the wealth plan as well, because that is also something we want to bring up. That it's not just investments, it's the risk in general. So if we have wealth enhancement, tax mitigation taken care of, the gaps that exist, then the risk of paying too much in tax is diminished. Or maybe it's just our charitable giving that we want to be taking a look at. And maybe it's the element of saying, where do we basically take from in order to do that charitable giving? The risk of taking from cash may be the fact that we actually have some stock that we could be gifting that would lower our overall taxes. So we can be gifting to charity while we are receiving that deduction, and we don't have to pay tax on that gift of the stock when they sell it as part of the charity versus us. Those are all elements of how we can lower our overall risk. So remember, if we take the element that risk can happen to any company and actually extrapolate that out to us, now we can start to say, how can we start benefiting us in every manner of risk management? And number 5, before I have a special bonus for you, is that risk can happen to anyone. You see, risk now can happen to any person individually in the same way it can happen to companies. And let's take a look at FTX. Now, I believe that the gentleman that was running it was worth something like $16 or $17 billion just a couple days ago, and he is actually bankrupt now. So risk can happen fast to anyone, and he's an incredibly smart guy. And let's take a look at Elon Musk. Elon Musk is the richest person in the world, yes, but he can still do things that maybe don't make sense and may not be good for risk management. So when we take a look at, say, his purchase of Twitter, he actually is having some issues with Twitter even right after he purchased it, to the point that maybe he's actually going to lose a lot of money in that investment. Maybe he didn't do his due diligence, but what that also shows you is that some of the smartest people in the world can actually lose a lot of money. So that also should give you pause to say, hey, how can I look at my own investments, my own level of risk, and what can I do to start mitigating those elements? And the special bonus for you, know your trend line. Okay, when we talk about trend lines, this is going back to investments in general. And when we take a look at investments, there are really two things we want to know about. What's the signal say? So are we above or below the trend line? And then the second element is by the strength. How much are we growing, or how much are we actually really kind of going down below that trend line? And when we know those elements, we can start to say, maybe this is actually a good time to get out if we're below that trend line. Or maybe it's a time that we want to make sure that we're invested either into that investment or making sure that we have enough invested in there to grow your accounts. But obviously we're taking a look at risk here as well, but that also comes down to those trend lines. So we want to know the trend line, and we want to know the signal that comes back to the strength. If we know those two elements, then when we take a look at anything, whether it's investment related in stocks, bonds, commodities, any alternatives that we have, even into real estate, we know where we're at right now and the likelihood of where we're going. And if things don't make sense to stay invested, if we're underneath those trend lines, we can get out. So do this when you're taking a look at your investments, is to know where your trend line is. And that's the 3-month or less line of each individual investment, whether it's a mutual fund, ETF, or even a stock, or yes, even a bond. All of those have trend lines. And if you stay above those trend lines, there's a higher likelihood, mathematically, that it'll continue to keep going up and grow. So with that, know your trend line. Because you made it this far in the video, I want to celebrate you. You see, most people start, but don't finish. Most people never actually follow through on the things they say they're going to do. They want a better wealth plan, but they don't take the action or do the work that's required. But you are different. And to show you my gratitude, I'm offering you a special one-on-one consultation to help improve your overall wealth plan. Because you are awesome. To see more videos on improving your overall wealth plan, check out this video right there. Keep making an impact on your financial future, and I will see you there.